What is a bull market or a bear market? How do we know if we're in one or the other? In this video, we'll go over a powerful indicator that has proven over time to determine when we're in a bull market or a bear market. We'll look back to 2013 and see how this indicator performed to see why it's so powerful. Bull markets and bear markets are two terms commonly thrown around in traditional finance. Despite this, there isn't any universal agreement on what it actually is. The only thing that's really agreed upon is a bull market is a prolonged period of increased prices, while a bear market is a prolonged period of decreased prices. But no one can really agree on what prolonged means and how much the coin needs to increase or decrease to be in one market or the other. Rather than comparing and contrasting the different definitions of a bull market, instead we'll focus on a powerful, time-tested and proven indicator that has proven time and time again that it is a good indicator of when we're in a bull market and a bear market. What is this powerful indicator? Well, it's a 200-day simple moving average. Let's jump on the charts and see what it looks like, and then we'll get into the statistics behind this indicator. As you can see here in the chart, I have plotted the 200-day simple moving average. When the price is above this, then it seems to just keep on ripping up. And when we go below, it seems to just drop. Of course, there's times in between where it'll sell down here and then it'll buy back above here, losing out on some profits. But over time, the huge trends that the market experiences more than makes up for this. Same thing in the past cycle. When it's above, it just keeps on ripping. And when it goes below, it just falls way, way down. And same thing way back here. It's nice to look at it visually, but it's not very special. You can't really get too much information out of that. So let's jump into some statistics and see how this 200-day simple moving average performed since way back in 2013. In this study, I looked at 3 different strategies. One was just buy and hold. The second was buy when you're above the 200-day simple moving average. And the third strategy was buy when we're below the 200-day simple moving average. So we can compare all 3. Within each strategy, I then looked at the exposure, so how often you're in the market. With HODL, buy and hold, you're in the market 100% of the time. But of course, if you're buying only when it's above the 200-day SMA, then it won't be 100% of the time you're in the market. Then we looked at the total days in the market, which is somewhat related to exposure. Then we looked at the final return. So if you bought and held, what return would you get after the end of that period? And lastly, we'll look at the expectancy, which is my favorite metric to measure a trading strategy. So if you bought and held from 2013 till now, what is the average daily compounded rate of return during that period? And we can compare that expectancy between above the 200-day and below the 200-day to see if there's any sort of difference between the two. To give you a visual, the first strategy will just buy and it'll keep on holding through ups and downs. Second strategy, we will buy only in this region here throughout this whole chart. And in the last strategy, we'll only buy when we're below the 200-day simple moving average. I'll try to put the results right here so you could see it as I'm going through it. Almost 9 years from November 2013 until just a few days ago. But as you could see, the buy and hold exposure was 100%. When we're above the S200 SMA, we're in the market about 56% of the time, and the remainder 44% of the time below the 200-day SMA. So we spend a little bit more than half the time above the 200-day. The total days in the market during this period, you can see all of them here. Now to the exciting part, which is the percent return. So if you bought and held from this date, you would have made 4,521% on your money, with only buying above the 200-day SMA and selling when you get just below the 200-day SMA. Your result is even higher at 7,217%. And that's only including being in the market half the time. If we go to buying below the 200-day SMA, you would actually have lost 37%. Think about that for a second. If you got into Bitcoin in 2013, an early adopter, and you just bought below the 200-day SMA during that period of time, you sold when it went above it because you thought, hey, the price is too high, I better sell. You would have lost almost 1/3 of your money. So you could see that the trend is your friend and the 200-day SMA is your best friend. Now, this is the most important part in my opinion, which is the daily expectancy. So if you're in the market for 1 day, what is your average daily return compounded during that period? So if you bought and held Bitcoin from 2013 till now, you would have made on average 0.12% per day. But for every day you were in the market above the 200-day SMA, you would have made double that per day, compounded. Meanwhile, if you would have bought below the 200-day SMA, your average daily expectancy would have just been negative 0.03% per day. But you may push back and say, well, almost half of that period was over 5 years ago. Things have changed. People have picked up on the 200-day SMA by now. They know how useful of an indicator it is, and they put in a bunch of money to exploit that indicator, which decreased its effect. So of course you would expect the 200-day SMA to lose its effectiveness over time as it becomes discovered. Well, as I mentioned earlier, the 200-day SMA in traditional finance has been one of the only indicators to hold up over time. Well, let's isolate it and look at the last 5 years only and see if the indicator has held up over time. If you look at the chart right here, you could see that the strategy of buying only above the 200-day SMA has in fact held up even in the last 5 years. It looks pretty similar to the whole time frame where you're in the market about 50% of the time above the 200-day SMA. And now moving on to the percent return, you could see that if you bought and held over the past 5 years, you would have made 378%. But if you would have bought above the 200-day SMA, you would have made 462%, despite only being in the market only half the time. There's a saying, it's not timing the market, it's time in the market. Although I do agree with that to an extent, these findings seem to challenge that statement just a little bit. Now, looking at below the 200-day SMA, you would have lost 15% over the past 5 years. And again, more importantly, let's look at the daily expectancy. You would have made 0.09% per day buying and holding during the last 5 years, holding Bitcoin. But if you bought above the 200-day SMA, you'd have made 0.19% per day. Let's take this one step further. Let's take a look at the last 2 years, from September 2020 until September 2022. In this case, the percentage exposure above and below the 200-day SMA is similar to in the last 2 years as the last 5 years, where it's about 50-50. Moving on to the percent return over the last 2 years, you could see that you would have made 77% in 2 years holding Bitcoin. You would have made more than that, 109% buying above the 200-day SMA and selling when it gets below, despite only being in the market half the time, half the risk. Then if you bought only below the 200-day SMA, then you would have lost 15%. Moving on to the daily expectancy, in the last 5 years, you would have made twice as much per day buying above the 200-day SMA than if you just bought and held. But in the last 2 years, it's even more than double. It's 2.5 times your daily expected return buying above the 200-day SMA. So as you saw, the 200-day SMA is an extremely powerful indicator, although it's extremely simple. Not only has it not decreased or diminished in returns over time relative to the market, it has actually outperformed the market more gradually over time. Although it's really great, it's only one indicator that we look at here at Tradium. TrendBot and MarginBot use this indicator to its advantage, but it also exploits momentum on slightly smaller time frames. In the next video, we're going to look at this 200-day SMA with volatility bands above and below this moving average to see when we can get extremely bullish and extremely bearish. We'll see how this new indicator with the volatility bands performed from the same period. Did it outperform the market? We'll also look at applying leverage when we're above the upper limit volatility band and see how that goes. The 200-day SMA and the volatility-based indicators in the next video that I'll go over will be some of the indicators and strategies that will be using in a DeFi asset management protocol project that I'll announce to you guys in the upcoming weeks. So if you would like to apply these strategies with an easy automated solution where you just have to hold the token and underneath that token it's being managed according to these strategies, then make sure to subscribe to the channel and check us out at tradium.io. Thanks for watching, and I'll see you in the next video.